Meme stocks. They're all the rage for 2021, but who's really making money on these? I believe the majority of retail traders are losing money in this area. So in this video, I want to share with you my best strategy for trading stocks like AMC, GME, and anything that's ME. So let's get going. Hey everyone, Tom Gentile. Welcome to Tom's Trading Room. In today's video, I want to talk about the best strategy that I can offer you into how I'm trading stocks like AMC and GME. Be sure to do me a favor right now and give me a thumbs up below. Hit the like button if you find this video educational. Also, if you're new to us, welcome to the channel. Hit the subscribe button, ding the bell. You'll get videos like this as soon as they're uploaded. Okay, let's go ahead and go now to my screen. I'm going to bring my screen up on the screen. And first, we're going to look at a chart of AMC. And the reason I'm bringing this up is because most of the folks that made money on AMC got in early. That means they were in before Memorial Day when this stock was trading below $15. It quickly shot up to above 70. And since then has been just volatility has been off the charts here. I mean, to have a day where we're below 40 and above 70 the same day on a stock like this is incredible, all right? But the problem is that most people getting in that day or beyond have been seesawed into and out of the stock, and the majority of the time, it's been for losses. So how can we take advantage of all this volatility and yet create something of safety on our side that also offers some probabilities that are in our favor? Well, one area I like to look at is selling option premium. And I first looked at selling puts on AMC months ago. Quickly found out that my broker would not allow me to sell naked puts on this stock without first giving them a phone call. Well, by the time I gave them a phone call and talked to the right person, the stock may have moved either in my favor or against me, creating a trade that I did not want. But I found a workaround on this, and I want to share that with you now. So if I go to the stock option table for AMC, and what I'm doing is I'm backing up and showing you what happened over the course of last week. So if you take a look at the options that expired on June 25th, I took myself back to the 21st, right? And I'm going to look at the options that are 30% above and below the stock price because you really need something that has a cushion on this. I want to put a trade on where I'm selling option premium. I've got some protection to the downside and possibly even the upside. And my objective here is to bring in premium, much like an insurance company would when they insure policies on houses and policies on life insurance. I want to take that premium in, and I want to reinsure, in this case, week after week after week, if it'll allow me to do so. So here's what I'm going to do. I'm going to come over. I'm looking at June 25 options. Let's go down and let's take a look at the put options right now. So the stock on June 21st was trading at $55.69. The 55 puts were $5.83. So it was going to cost you more than 10% of the stock price just to buy a put option or buy a call option if you believe the stock was going up. Well, it warrants that kind of price. You know why? Because this stock likes to move around a lot. So what if we were to go down and obligate ourselves to purchase the stock at 45? So at $45 a share, if I sold that put, I'd be bringing in roughly $1.45, $1.46 at this time in premium. That's $145 per contract. Now, two things come to mind. Number one, what if AMC goes to zero? Well, then I'm on the hook for for at least 100 shares of stock per contract because it's going to get put to me. But number two, most brokers won't even allow you to sell naked premium in the stock. So how do you get around that? Well, you do what insurance companies do. You reinsure and get yourself some protection. In this case, what if we were to come down and buy the 40 puts? What we've done is created something called a bull put spread. This is a bullish opportunity as long as the stock stays above 45. by expiration, we get to keep the net proceeds. What are the net proceeds? I'm going to go to my risk channel, and I'm going to show you that by doing this, you're going to bring in around $90. Now, you're going to risk, in this case, $410 in the event that AMC is below 40 by Friday. So think about this. For those of you buying the stock right now, you're paying $55 a share. If we go down to 40 or 35, you're going to be down 20 points. You're going to be down $20 per share, 100 shares. You're talking about a $2,000 drop. So I'm okay losing $410 on a position that if I own the stock, I could be down $1,500, $2,000, $2,500 or more. But the main point of this is to look at really the probabilities. Where do we stand to be on Friday? And Friday shows me we have a 94.7% statistical probability that AMC is going to be above 40 come Friday. So you take a look at this trade. Here's what ends up happening. So now what I want to do is I want to walk with you through what this stock did over the course of the next few days. So down here at the bottom, you can see that that's the quote, $90. Let's go plus a day, and let's see what happened to this. Now, look what ended up happening. Your $90 is already up $60 in profit in one day, all right? Let's move to plus a day again. Now we're on Wednesday, and you're up $78 of a possible $90 move. Why? Well, because remember that put option that you sold for $1.46? It's now trading at 28 by 30. You made $117 on that position. But the put option you bought, and you bought it for 56 cents, that's for protection. Well, that's down to 16 by 17. So you're losing money on that trade. But combined, when you combine the two together, you have a $78 profit by that time. Let's go ahead and see what ends up happening. And you go into the final part of the day, and even with 1 day left to expiration, this $90 credit, you're now up $84 out of a possible 90. Now, let's say that you were bearish on AMC. You were going to do this. You wanted to be on the bear side of this. That wouldn't be the worst thing in the world to do either, because if I were to simply come in here and clear this out, and let's look at the call options. Again, stock is at $55, right? Look first at the chart. Where's all the activity happening? It's all happening right around the $60 to $65 level. Let's say we're going to look at 65 or even 70 as a potential area to be a seller, thinking that the stock was not going to go above 70 by Friday. Well, this is what it would look like. We're going to look at these call options all the way down. Look at the 70 calls. The 70 calls, the 65 calls, first of all, are trading for $3.58. If I sold the 65 calls and I bought the 70 calls for protection, what I'm doing is I'm selling a lower strike call, buying a higher strike call. And what can we do that for? Let me go ahead and run that in. That risk graph is going to look like this. The trade is, on the call side, is only going to bring in $83 worth of credit. But once again, if we move forward, watch what happens. You're 83, okay, it's down $7, right? Next day, now we're looking at Wednesday. Now you're $83. You've actually collected $29 of that 83. By Thursday, you're now collected $64 of your $83. So what I'm doing is I'm showing you a way, which I believe is my best strategy for playing meme stocks like AMC, GME, etc. I'm showing you my best way to go in and play these stocks. Couple questions that might come up right away. Number one, do you use technical analysis to help you in this? Yes, I do. If I see a stock that, like a meme stock, that has higher lows and higher highs, I might do the bullish put spread and forego the call spread, right? The other reason why is because we know that stocks have a floor, and that's zero. But there are no ceilings to stocks. And the way these meme stocks seem to be going is that anytime they have a considerable down day, you see this rush of traders come in and start to buy those bottoms and prop that stock up. So I really love the put spread over the call spread just for that reason. Now, next question could be, why can't you do both? Why can't you sell the put spread below the stock price and also sell the call spread above? Would you take in double? Yes, you would. Let me go back to the screen. I want to show you one more time how that looks. We're going to go back to our our options quotes. So let's go back to our option quotes. And this time what I'm going to do is I'm just going to add in that 40 put that we bought and that 45 put that we sold. This particular trade is known as an iron condor. An iron condor looks like this. You're going to make all your money so long as the stock closes in this range here. All right, what is this range? 45 to 65. All right, look at what the stock's been doing the last couple of weeks. It's been staying in that range. If we expect it to still stay in that range over the course of this week, the next 4 or 5 days, then we could stand to make money on both. Notice in this particular case, your credit is $173. That's the credit from the put side and the credit from the call side. What's the worst we could do? Well, if we go outside of either of those two ranges, the worst case scenario is that we're going to risk $327. How do you come to that point? Well, you take that spread, all right? It's 5 points on the call side, 5 points on the put side. Take the 5 points and subtract what you brought in. So 5 points minus $1.73, that comes to $327 worth of risk. Finally, go down and take a look at the probabilities on this trade. The probabilities that we're going to stay inside the window are 85%. 85% probability that by expiration, which is only a few days away, that we stay inside that window. So what does that mean? That means that I have a high probability trade. And in this case, I'm putting that trade on. Look where you go by the end of the week. All right. I'm going to bring this up to the end of the week, and you're going to see, looking down here at the bottom, that you've now captured $148 of a possible $173 trade. So can be done 3 ways. Bullish by using a put spread, bearish by using a call spread, and what I like to call bullish using a combination of the two, right? So there you go, guys. That's my best strategy on how to trade these high volatility meme stocks such as AMC and GME.